Okay, so let's talk about the systematic risk. That we know it as also the market risk. So this risk is about what this risk affects the performance of the entire market. So entire market will be affected with this systematic risk or the market risk rather than the particular stock or industry sector. So when we have this systematic risk, what might happen is that in the market, in the CHX, in Nasdaq, for example, so we have a negative effect and we have a decrease in what? In the prices, or a kind of change in the prices that has a negative effect on our portfolio. So we want to see that how these kind of things might happen for the different markets and how we might have the market risk and what is the solution. If we have this kind of risk, what we can do. So basically this kind of risk that they affect the entire market or not a special sector of the industry or the economy. Sometimes it's coming from the problems that we have in the economy. So imagine that the people that they are living in the country, they face with problems, and those problems might increase their need to money to have the same products that they used before. So they might ask for more money, okay? As the help. Because of what? Because of, for example, the inflation, or it could be because of the recessions, okay? That might be because of the inflation in the economy. It could be because of the different events that might happen in the different geographic part of the world. Like war, for example, if we consider it as one of the things that might affect the economy, okay? So the war could be one of them, and the people might like to solve the problems, or the governors, or the different investors, or people that they are active in the economy to make what? To make the peace, because the effect of these kind of things on the economy is very harsh, and they are very difficult situations to be managed. So we have some geopolitical events that they might make the systematic risk. And remember, this kind of risk affects the performance of the entire market or economy, not a particular sector. And also what we might have, not the war, not the recessions, not the inflation, not any problem for the economy. It might be because of the natural disasters. Okay? Like what is happening nowadays, okay? In the nature, so we have some problems that might arise because of the different problems that we have in the nature. So these kind of things might also affect the economy or the situation of the market, and then we might see that we have the systematic risk or the market risk. Okay, so the market risk and systematic risk, they are important to be studied, and remember that this systematic risk has some similarities with the systemic risk, but they are not similar things. So for systemic risk, that is also a kind of risk that might affect the entire economy, but it is coming from where? From the interconnection of the financial institutions, that they might make an effect like a domino effect. So it might make a big effect on the whole economy. But the systematic risk, they have also the effect on the negative effect on the whole market, but not a specific sector, and it's not coming necessarily from the interconnection of the financial institutions. As you can see, the natural disasters, for example, they might have an effect on the country, on the total, on the whole of the economy, but it's not because of the interconnection that we have, or the correlation, or the financial system interconnection. So the systemic risk is a bit different with the systematic risk, and the systematic risk is called also the market risk. And when we have the decrease or a problem in the financial part, the market risk will be there. So it is because of what? As we discussed here, because of the price changes, okay? So the changes that we have in the prices, like a decrease that we have here, might make the market risk. So the systemic risk is what? If we want to write a definition for the systemic risk, to know the difference between the systematic risk or market risk with the systemic risk, we can say that systemic risk is the possibility that an event at the company triggers some severe instability. Okay, so it makes some instability that this instability might have some effect on the entire industry or economy in a negative way. Because of what? This point is important. Because of the linkage within the financial sectors. Okay? So the market risk is the possibility that an individual or other entity will experience losses because of what? Because of the factors that affect the overall performance of the investment of the financial in the financial markets. And this is the result of something bad might happen in the economy or in the financial market, that they can change the prices. So basically, the important point is changes the prices, okay? And it's not necessarily coming from the linkage within the financial sectors that we have for the systemic risk. So we call it the systematic risk or the market risk, okay? So when the prices are changed, we might have some changes, okay? Imagine that we have the prices on top, so a good situation for the investors, everybody is happy here, and then finally we can see that there are some changes here and some drops, okay? So the people are not happy anymore. Okay, so the changes in the prices, so imagine that this is graph of price in the market, and we have a big change in the price, and these changes are important to be monitored. Okay? So first, we might need to remember that the systematic risk is a little bit different with the systemic risk that was the cause of the financial crisis in 2007-2008. The second thing that might be important about the systematic risk and the market risk is that the systematic risk and market risk is also different with the specific risk, okay? So it is not also a specific risk, okay? So what is this specific risk about? So remember, a specific risk, or also we can call it unsystematic risk, involves the performance of a particular security, and it's not about the whole economy, so it is about the particular security that can be mitigated through what? The solution that we might recommend for a specific risk might be the diversification, okay? So this is different with the market risk or with the systematic risk because of what? Because the systematic risk, it cannot be solved by diversification because it affects what? The all investments to some degree. And market risk may arise due to changes to different things because of some events that might happen, like what? The changes in the prices, the changes in interest rates, the changes in exchange rates, geopolitics events, the recessions, inflation. And when we have these kind of problems, the whole economy and all sectors, they are affected. So you cannot mitigate the risk simply by doing the diversification, right? So this is the difference between the specific risk because it is for a particular security. We can solve it by diversification. But for market risk, as we said, the market risk may arise to what? The market risk based on some changes to exchange rate, for example, to interest rates or geopolitical events, natural disasters, recessions, inflations. And when we have these kind of problems, they might make some problems for what? For the markets, that we can see it as the decline in the prices, that we call it the price volatility. So this price volatility and term of volatility is something that we hear a lot when we are talking about the market risk, about the systematic risk. Okay, so the price volatility is very important, and this price volatility is about what? About the changes, as we said here. Okay, so we have the changes. Okay, in what? In prices. But which kind of prices? The prices could be the prices of stocks, okay? It could be the securities, it could be the commodities, and these changes in the price of the stocks, securities, commodities, that we call it volatility. they make some market risk, okay? This kind of market risk that they are important for us to be monitored and to be measured by changes in the prices of the stocks, securities, and commodities might happen, and it makes some kind of risk, some kind of market risk, okay? That we call it what? For example, based on the interest rate that we say here, the interest rate that might be changes, so we might call one of the market risks as interest rate risk. Also, we have some changes in the prices like the equity prices. So we can call it the equity price risk or the price risk. We can have this also the market risk as the changes in the values of the currencies. So the currency risk, that we call it also the foreign exchange risk, okay? It could be the changes in the prices of the commodities, okay? So the commodities that we have here. So we can have also the commodity risk, that is the changes in the price of commodities. The commodities are like what? The crude, oil, and etc. Like maybe and also corn, that was important, and you could see that we had some problems also for some of them because of the war. So these are the kinds of the different kinds of the market risks that might arise because of the changes in the prices. These changes of the prices might happen for the stocks, securities, commodities. The cause or the reason that we have these kind of changes in the prices might be from the economical reasons. It could be the geopolitical events. It could be some natural disasters that might happen. And finally, we have this kind of risks that they cannot be simply managed by diversification. And we have to use the hedging and immunization and different kinds of the methods to deal with this kind of risk, or we have to, we must anticipate this kind of risk to manage it in the right way. Okay, so this is the definition of the market risk, and all we need to know about market risk and the differences of the market risk with the specific risk and also with the systemic risk that we talked about it in the Basel Accords and the financial crisis that we had in 2007-2008. And now the thing that we might like to know is that how to measure this risk, okay? Because if we want to manage the risk, we know that we have to measure it first. So if we want to measure it, so for the measure of the market risk, we have several solutions. One of the solutions is the most famous one and maybe the most important one is the VAR or value at risk. Okay, so VAR or value at risk. Okay. So this VAR or value at risk is what? It is a statistical measure that calculates the maximum potential loss. So it is talking about maximum potential loss of the portfolio that can be experienced over a given time period. So the first characteristic is this maximum potential loss of a portfolio. The second characteristic is the time. The third one is the confidence level. So because it is a kind of a statistical method, so it is talking about the maximum potential loss that might happen for the portfolio in a time period, in a period of time. And we have also a confidence level. Okay, so we are talking based on the confidence level, and we can have that in our calculation. That is good. So, for example, the 95% chance that the portfolio would not lose more than the calculated amount over the given time period. So the confidence level also is important to be identified. So the VAR, for example, is measure the VAR of 95%. Will give us this information or this confidence that there is a 95% chance that the portfolio would not experience that calculated amount of the loss over that given time. Okay, so this is a very nice measure that if we know about it, we know a lot about the market risk. And it is coming from what? From the price volatility, looking at the historical data or doing some calculation based on some statistical distributions, because this method is what is a statistical method to calculate something related to the market risk and know about the price volatility. The other method that we might mention is using the beta. And the other method that we might use for the market risk is the ERP, or the equity risk premium. So ERP or equity risk premium. That is what? That is coming from subtracting the risk-free rate of the return, usually the yield on the short term or mid-term of the governmental bond, from what? From the expected return on that stock market. So the expected return of that the stock market minus the yield on a short term or mid-term. Governmental bonds. That we can consider it as a kind of risk-free asset. Okay? So we have also beta that measures what? The relative volatility or market risk. So this is also a kind of measure for the market risk. And this measure for the relative volatility or market risk is working like what? If we say that beta is, for example, beta of 1, it indicates what? It indicates that the stock has market risk identical to the S&P 500, but if it is greater than 1, it means that the asset is more volatile. Than market. So that is also a measure for the market risk that we can calculate, and we can look at the number to see that if it is 1, so the performance is similar to what we have in the market in S&P 500, for example. If it is greater than 1, then the asset would be considered as more volatile than the market. Okay. So now some questions and assignments. For you to think about it. based on what we discussed. So the first question is that list the different types of the market risk. So maybe the first one, what are some types of market risk? So the question number one. The question number two, that you might like to think about it and say that if you got the point from our discussion. How is market risk measured? Okay, so remember the VAR and different measures that we have for the market risk, to know about the market risk and to have a measure about the market risk. As we have nowadays inflation in the economy, maybe the third good question to think about is that if the inflationary risk a market risk? So we know that the inflation can make the recession maybe, and that might be the cause of the market risk. But the question here is that if the inflation risk is especially a market risk or kind of market risk, so remember the types of the market risk that we listed, and if you could see the inflationary risk included in that list, and then you can come up with the answer of this question. So we have also the specific risk, right? So maybe the fourth question could be, what's the difference between what? Market risk and a specific risk. Okay. So these are the questions that you might like to think about them, and send me your ideas about what do you think about the answers of these questions. But we can also consider a scenario about the commodities, about price changes, about the volatility. So let's consider some changes in energy. Okay, so consider the oil. Okay. And scenario is about what? Suppose that there is an investor, okay, that has a portfolio of the oil stocks. So and for this portfolio of oil stocks, we have one of the measures for the market risk, the beta, and the beta is 0.2, okay? And let's consider the beta as 2. Okay, so beta 2. In that case, it is less than 1, but the market beta is always 1. Okay? So let's consider it as 2. So the market's beta is always 1, and since the market beta is always 1, for the portfolio, this portfolio is theoretically with beta 2 100% more volatile, right? Than the market. So, imagine now that if the market has a 1% move up or down, okay, so let's consider that we have a decrease in the market to represent the risk that might face with, as 1% move down, our portfolio that was about the oil stocks, that will decrease with what? 2%. If it is 1%, our portfolio is 100% more volatile than the market. And if the market moves down for 1%, then our portfolio will move down 2%, right? So there is a risk associated with this sector. We have a risk here. This risk is about what? The whole sector. Due to increase in supply of the oil, okay, for example, if we have a problem in the supply of the oil in the Middle East. It can cause the what? The change in the price and the value. So if the trend continues, the portfolio will experience a significant drop in value. Okay, so these might make a significant drop in the portfolio value. So the investors might like to do what? To diversify this risk, since it is what? It is about oil industry, and as it is for the oil industry, it means that it is industry specific, right? So analyze this scenario and answer the question number 5 by analyzing this scenario, that if it could be considered as the market risk, is it the market risk? Or a specific risk? Okay? So 5 questions to think about it and give me your feedback to see that if we understood well what really the market risk is talking about.